Welcome to the latest episode of Quest for Twice. This is the first half of my year-end edition of Quest for Twice. So in this episode, I'm going to review my 2021 investment performance as well as lessons learned. In the next and final episode for this year, I'm going to review my portfolio positions and planning if any adjustment to my portfolio. So as of December the 8th, S&P 500 returned 26%. And my personal return is 73%. So this graph shows my return versus S&P 500. My investment performance is described by the thick green line, and the S&P 500 is the thin gray line. And under the graph, it shows the monthly performance of my personal return versus S&P 500. What's particularly satisfying is that almost each month I either beat or kept up with the S&P 500, with the exception of the July and June. I believe the main reason behind it is because most of my stocks are considered value stocks. And this year, the value stocks generally did better than growth stocks. So another way to look at my investment performance is to look at each individual stock I invested. So I created this histogram with the number of stocks in different performance bin. So most of my stocks, 5 of them, have a similar performance as S&P 500. That's between 15% to 35% range. However, I have one stock that returned more than 160%. That's AdCore stock. I did a deep dive about AdCore in the last episode. Because of the investment success, now AdCore is 41% of my total portfolio in weight. Another interesting observation is that another 4 stocks beside AdCore also beat the S&P 500. And their total weight together in my portfolio is 27%. So add those 4 with AdCore, that's 68% of my portfolio beat the S&P 500 in this year. And that's why I have a significant outperformance compared to S&P 500 in this year. I also want to talk about my underperformers. So I have one stock, that's Poshmark, had a significant underperformance. So just on the absolute term, it returned about minus 50%. So it's about the last half of my investment in that single stock. However, it's only a small portion of my portfolio. Currently, it stands at about 1%. I also have 2 stocks had a negative return less than negative 5%. And 3 stocks returned less than S&P 500, below 15% return. So what's interesting about those underperformers is the fact that almost all of them are considered growth stocks. As I mentioned previously, I am dipping my toes into investing in growth stocks, so I'm still learning. So my underperformance, part of it is due to the fact that I'm paying a tuition to figure out my own way to invest in growth stocks. Another reason of those underperformance is because of the simple fact that the value stocks generally did better in this year than the growth stocks. So in summary, at the end of 2020, my portfolio was about 4.7 years of my former salary. In July of this year, I added about 6 months of my former salary additional capital into my portfolio to invest. Now it stands at about 8.5 years of my former salary. Oh, so that's 73% investment return. I gave myself a A plus for capital efficiency because I significantly beat my benchmark S&P 500. For risk management, I give myself a B. The reason is a single stock, Aqua, contributed 2/3 of my 2021 total gain. So there is a significant concentration risk. However, I do think and try to manage this concentration risk by focusing on Adcore's underlying business, its valuation, and its growth potential. So I believe it's a very solid business, and I think it's still undervalued. For those reasons, I think the concentration risk, although it's high, but the risk to my portfolio performance is managed. So for materiality, I give myself A plus, and that's because as the name of my video blog, Quest for Twice, that's measured against my former salary. So in this year alone, I made more than 3 times of my former annual salary. So because of the underperformance, I want to take a closer look at my growth portfolio. As of December the 8th, my growth portfolio is about 20% of my total portfolio. In the pie chart at the top right of this slide, it shows the stocks in my growth portfolio. In terms of my invested capital, Mercado Libre now stands at about a third of my total capital invested in the growth portfolio. And Amazon and Emote adds about a third as well. So the rest of my growth portfolio were distributed among JFrog, Boston Beers, and Poshmark. So as of December the 8th, with the stock price move up and down, the biggest change happened to Emote. Now it becomes 24% of my total portfolio. And Poshmark, as I mentioned earlier, now it's only 6% of my total portfolio because of almost 50% loss of my invested capital. In aggregate, I had a negative 2% investment return for my growth portfolio versus negative 3% for the US small growth in the last 3 months. However, that's actually obscured the fact that for some very risky, high growth small companies, they actually suffered a significant loss in the last month. So as this chart shown, there is a Goldman Sachs non-profitable tech basket. So in the last month, that index lost about 30% of its value. And some of my stocks are considered belong to that tech basket, including Mercado Libre, JFrog, and Emote, and Poshmark. So because of the inherent difficulty to predict the future business return and the high volatility of the high growth small companies, so risk management is really important. So my risk management approach is number one is diversification. Now I have about 6 stocks in my growth portfolio, and I will continue to look for new ones to add. Another one is to understand the moat. If the company has either narrow or wide moat, then its future business will likely do well and to support the high expectation for future growth. The third one is pay attention to valuation. That's, for example, I use duration to parity as a metric to look at how far the stock may underperform. And that's a metric related to the valuation for growth stocks. Now let me summarize the lessons learned. First, I want to review the lessons I learned from 2020. So because my motto is do not make the same mistake twice. Number one, selling a stock needs a strong conviction and purpose. So I learned that last year because I sold some of my holdings too early, and that was a mistake. So in this year, I made the exchanges and selling some stock and used the proceeds to buy new stocks. But I did not do any outright selling to bet against the market. Number two, do not nickel and dime the market. Last year, I tried to add a position in Adcore stock, and I missed a few good entry points and had to purchase at higher entry points because I tried to nickel and dime the market. And now with the significant price increase, I can say that it really did not matter last year to try to nickel and dime. The most important thing for a good company is to actually own some of its shares and do not worry too much about the absolute low cost in my ownership. Number three, if lesson from last year was market can be irrational. Alcohol is a good example. Alcohol did really well. So probably the good question to ask is why Alcohol stock was sold so cheaply in last September and October, or even November after 30% increase. So my answer is market can be irrational and misprice companies. And I think that presents opportunities. So with the recent significant sell-off in the high growth company and energy sector, I do wonder if we are in another episode of irrationality currently. Only time will tell. So for this year, my 3 lessons are mostly related to the Poshmark stock. So this top right chart shows the stock price of Poshmark from June to early December. I marked the 2 entry points. I purchased the Aqua stock. So one lesson I learned is cheapness is not a good reason to buy a growth company. For example, Poshmark stock price was $100 in January of this year. So in June, I started buying when it was about $45, and that's a significant reduction from the January price. So one can argue that it was becoming cheap, but it kept going down. So in early August, I bought again at about $35 per share. Then as this chart showed that its stock price continued to suffer. The underlying reason for the stock price decline was because of business performance. So if Poshmark cannot grow its business, for example, at least based on the most 2 recent earning reports, it has no growth on a quarter-by-quarter basis. Then its stock price has a lot of space to fall further, and the stock price decline in this year I consider is justified. Therefore, cheapness is not a good reason to buy a growth company. We buy a growth company because of the growth. The second lesson I learned was that don't buy a company I can't understand. So for Poshmark, its main customers are Gen Zs and millennials. I really don't have any insight in their consumption behaviors. So it's very difficult for me to have any confidence in its future business aspect. So I didn't really understand Poshmark's business when I bought Poshmark stock, and that was a mistake. The third one is don't be sloppy during investing. That means I need to stick to my investing process and don't take shortcuts. For example, I did not do a deep dive on Poshmark, and I could not articulate its risks and moat, if any. So if I did a deep dive on Poshmark, then with my process, I would have to articulate its risks and business prospects and moat. I did not do that because I considered that was a small position in my portfolio, so I was sloppy. Turns out that was a mistake. So all these 3 lessons were from investing in growth stocks. I consider them as my tuition paid to learn and get better at investing in growth companies. Hopefully, they will benefit my portfolio performance in year 2022. And to make a plug for my final episode of Quest for Twice in this year, in the next episode, I'm going to review in detail about my position size in the different companies I currently own, and my mode and valuation analysis of those companies, as well as my prediction of their performance in the year of 2022. Stay tuned. Until next time, happy investing.